In this episode, I'm going to be using some of the liquidity pools or liquidity points in the market that I use a decent amount. Now, I do have a course that is paid where I do go over my top 5 that I use pretty much 99% of the time. But because this is a free boot camp, I'll be going over only a couple. And again, if you watch my last video, screen time, you'll slowly pick them up on your own if you trade for years. Okay, I'm telling you, you will start to see things in the market that you're like, oh my god, I know this liquidity point, or I know this high is likely to hit because of this. So like, you're going to pick that up through screen time, or maybe, again, you can buy my course if you want. If you have the money, I would, but if not, I don't want to promote it. But yeah, like I said, I'll be going over a couple. Yeah, so the first liquidity pool I'm going to be going over that I always use are equal highs and equal lows. I always use them. Now, I'm gonna show you guys a couple different weights I put on equal highs and equal lows. So this is the least significant. Okay, let's say we have two wicks and they look like this. They're right next to each other. This is the least significant. While these can still definitely matter, they're definitely the least significant because they're right next to each other. Now, let's say we have a third one like this. I would say that these are much more significant, and these are, let's say these are 50% are likely to hit. So 50% of the time, stuff like this, we will trade right back to them and go hit them, okay? Again, imagine if you had like a candle right here, okay? Now, let's say we had another wick, a third wick here. I would like totally up that to like, okay, now 80% of the time, maybe even 90%, we're likely to hit these equal highs, okay? So these are definitely the weakest when we just have a pair of two next to each other. And then I would say these are definitely like 80, 90%. We're going to go back and hit these highs because, again, you got to realize that there's a ton of stop losses above here. That's where the market's going to target. And that's all the boot camp is focused towards. Where is the drawn liquidity going to be? Where is the market going to target? It's going to target these smooth highs and smooth lows. So a lot of times, like 50% of the time, you will see these highs traded back above or below. Again, if we have them, they can be switched around if we're bearish. 80, 90%, this is where it starts getting like, okay, this is very significant. Now let's say we actually wick could tick above. I would not count these, okay? Just goes back down to like, okay, 50% of the time we're going to go back up here. But if you ever see like triple equal highs like this right next to each other, they're pretty significant. It's going to be a really good target to scale at. Now, the next one. Let's say the wicks are more than a couple of candles apart. So let's say it looks like this. Let's say they're like this. I would say these are about 70, 80% significant again. So it actually, this is weaker. And then I would actually say this is stronger. This is going to be a stronger magnet. Okay, so this is the weakest magnet of equal highs and equal lows. You'll see they're right next to each other. This is where it starts to get really strong again. Because imagine if you saw a candle and then 5 minutes later, a same candle printed the same exact high. Now, if we know the NASDAQ is sitting at 17,836.75, that is a very big number. What are the chances it forms the same high to a tick 5 candles apart? Not very likely. So when it happens, we're likely to go back to those highs like almost immediately. Or let's say we get a first down move. That first long you see, I would take it and target those highs. So equal highs and equal lows like this are very significant. I love targeting them, and they will hit a lot of the times. Now, when do these matter? Well, these are only going to matter mostly during the kill zones, okay? Make sure you're only targeting these during New York and like London. A lot of times in the Asia session, which I'm not going to go over right now, you will see a lot more equal highs and equal lows. So this is the Asia session. You can even, like, you can see these are the weakest equal highs and equal lows, but you can see there's two wicks up here. 1, 2, 1922, 1924. And they actually are taken, and then they reverse right away. But you can see right here, again, they're just not going to be as good to target during Asia. You mainly like to see these during New York. But you can even see during Asia, they still are targeted quite a bit. See how we form equal highs here, and then the market just goes to them shortly after. So these are the best liquidity points for sure. You could just sit and wait for these all day and be profitable. Let me show you some examples. So if we go to the 1 minute chart, you're going to see some examples of these really small like ones that are going to be right next to each other. So let me see if I can find a few. It's like right here. Okay. So again, these will be hit. Now, dude, this is where like it's so hard. You guys don't know how hard it is to make this boot camp because I can't teach some of this stuff. Like this is it gets so to the point where it gets so complicated and you're not going to be able to learn this unless you have years of experience. You're not going to be able, like you need this. There's going to be things you need to notice by yourself. This is one of them. So let's say I see these two equal lows. Well, anyone new watching is like, well, we have to hit them, right? Well, how do we hit them? What do we have to do to hit them? There's so much that goes into account. Now, let me tell you my thought process here. My thought process, okay, we left equal lows here. Probably maybe going to take a high and then go back down. Whatever. I'm just going to, it doesn't really mean anything to me at the moment. I'm just going to kind of watch. So I see this red candle. These aren't really that significant. So like in this point of time, if we got a really big impulse move, in my opinion, I would low key long it maybe. Like let's say we violated or went above this bearish gap. We formed a new bullish gap and we violate everything in its way. Well, then I don't really think we would go back to these equal lows. I think we just keep going higher. And yeah, that's what I would think. All right, let me play price. Okay, now we kind of got another low that came within a tick or 2 ticks of these lows. So now it's kind of interesting me a little more. Now I'm kind of leaning towards like not longing if we get a nice move up here. Like these are kind of becoming more significant. We kind of got another low that came really close, but then it hit. That usually means we're going to go back down. Let's play a few more candles. Okay, now we have a 4th wick. It comes really close. We have 2 sets of equal lows now, here and here. Now I'm like, okay, there's no way I'm longing. I'm going to get wrecked if I long. There's 4 equal lows here. They're all next to each other. There's no way we don't go up without taking this first. Now, what if we do go up without taking them? I don't care. I'm not long in this. I would never trust an up move, especially with these lows sitting here. Maybe 5 minutes ago I would have without this low and without this low. But now it's like I would not trust that. And I would really immediately think, okay, we're now going to go to the lows. Now, based off the entry model video I did, is there an entry model here? No, there's not. This is just gambling, but it still shows you how significant these lows are to be hit. This is really choppy. I would never trade this. But again, hopefully my thought process there kind of helps. And what my thought process was about 3 to 4 years of experience. And you're not going to understand that until you trade for 2 or 3 years. Some people are like, well, how are you supposed to catch a short? You're not. It's just a tape read. It's really no way to get in here, you know? And yeah, you can see we never really left any more equal lows or equal highs. I mean, you can see like this got taken out by a tick, so I wouldn't really count these. I mean, this got taken out right here, so nothing really of interest anymore. So yeah, so going back to kind of the significance, I think the most significant equal highs and equal lows that are always going to be hit are like ones that are like really far away from each other. So if you ever see something like this, really far away, mark them in your chart. They're going to be hit at some point or another. Now, the biggest mistake I see people make with equal highs and equal lows is we'll be downtrending and we'll be respecting every single bearish gap. And people will be like, oh, we're bullish, we're going to go for these equal highs. And yeah, we might be bullish, but not at that certain time you might be saying that. Just because there's equal highs doesn't mean we're bullish. Wait till we get the price action or wait till we get the momentum to the equal highs. And then you're like, okay, now we should hit the equal highs. Now we have momentum towards them. That's a good time to maybe enter a trade. So that's the other big mistake I noticed of these. So yeah, you can kind of see like, let's see if I can find some more examples of equal highs and equal lows. There's one the other day. It was very, very textbook. I think it was Tuesday. Oh yeah, it was Tuesday. So Tuesday during the Asia session, it was right here. A lot of people would have missed this. Now we get right here. We got 1, 2, 3, 4, 5, 6, 7, 8, 9 equal lows in a row, perfectly placed. And you're going to learn through screen time. These are always going to be hit. Now, these formed at 4:39 p.m. This is not a kill zone. As I said, kill zones usually run liquidity, not this random time. So we never even ran these lows until we kind of opened up and got that New York kill zone. So if I had a strategy this is right, you're going to see, again, you're going to see these eventually were targeted during the New York kill zone. You can kind of see London session was from 2 a.m. right here. This is where it started to 5 a.m. here. And they were not run during London. And you can see after the London kill zone, they were not run. So where do we expect them to be ran? To New York kill zone. And this is where people mess up because people are like, well, there's equal lows below. We got to run them. And all of a sudden, they see this big, giant green candle, and they're like, well, I'm going to short anyways. I don't care. And they don't wait for price action to actually turn bearish. You want to wait for price action to turn bearish. Seeing bearish price action and guessing we're going to go to equal lows are two different things. And we don't really turn bearish here until we get this big dump. Once we get that big dump, that's where I look for like a retracement or something to get in. Obviously, these bullish gaps were broken. Okay. Again, here's another thing you'll learn from the screen time. What should happen if the bias is bullish? Well, these gaps would have probably been respected if the bias is bullish. And the fact that they aren't tells me we're probably going to go lower. That's just common sense. So, again, a lot of people like you will miss these at times. I even miss these sometimes. But someone actually noted these in my chat. They told me about them like, wow, there's no way we don't go there. So I had them marked. We started to get the momentum towards them. And then I took a few shorts and I just targeted those equal lows. Very, very nice. Very, very nice target. Hit pretty easily. And that was that. So, like, though equal highs and equal lows are definitely my favorite targets. I'm not going to be able to teach you everything I know about equal highs and equal lows. Like a lot of people ask me, will these count at equal highs? I would say no. Okay, they're just, if they're going to be this close to each other, they should be to the tick. They should be to the tick. The only time I'll ever count equal highs and equal lows are a few ticks apart. If they're like really far apart from each other, like, oh, this is perfect. Look at this right here. So look at this. We formed these equal highs right here. You can see this 1051 candle. The high was 17705.25. What are the chances another candle literally 3 hours later forms the same exact high? Not very high. Now, what do we do after? We just dump. So we don't really get momentum. Now, here we start to get momentum. So maybe you would long this right here, okay? Right, maybe you'd see like, oh, this is a market structure shift. I'm going to take a pullback into a fair value gap, but we don't really have any fair value gaps here, so there's not really any way to get in. And then you target the high. So it might be like maybe I scale half at this high. Maybe I take off half my position here, and then I get stopped the rest at break even. Now, this is where it gets advanced. There's too many variables to teach. I can't teach everything. Obviously, in this example, there's earnings at 405. That messed everything up. So these earnings obviously messed everything up. So maybe you wouldn't have taken a trade here. After earnings, we just get bearish price action. I go to sleep here. I go to sleep. I go to sleep. I go to sleep. Here's the next day. Okay, we see a reversal the next day. Very nice reversal. Now we get momentum back up. So as long as the market structure stays bullish here, where do I expect us to go? Back to these highs. Okay. Why back to these highs? Well, they're equal. There are so many stop losses resting above these equal highs. Imagine how many stop losses rest above those highs. Highs like that will never just be left randomly. Okay, you will learn that through screen time. And you can see earnings the next day actually ended up hitting them, and you can see the momentum through them was pretty nice. The one thing I will say is if we ever get momentum through equal highs, it doesn't mean to long. You never long after equal highs are hit and never short after equal lows are hit. Wait for more structure after. Write that in your notes. A lot of people, they take a long and a fair value gap right after equal highs are hit. Ideally, you want to be in the trade before the equal highs are hit because this is almost a guaranteed target every time. That's going to hit a lot of the time, not financial advice. So, yeah, equal highs just one of my favorite targets, equal lows as well. And yeah, you'll see them hit a lot. Just make sure we actually get the price action that tells us we're going to go hit them. You can definitely experiment, but you'll start to see a lot of equal highs and equal lows formed intraday if you look closely enough. There's not too many examples here. Like these are here's another example. Like these aren't perfectly equal. This is actually tick off, but they definitely become more significant once this wick comes down here and we don't hit them again, because now we kind of got relative equal highs. So these are relative equal lows. So these would be relative now. I always say this: if you can back away 10 feet from your screen and see them on the screen 10 feet away, they're probably significant. They probably look like support to a classic retail trader, and a retail trader is probably going to long off them. So again, I feel like you could see these 10 feet away from a screen and they'd be significant, meaning they're probably going to get hit. All right. Now, the next liquidity pool is London high and London low. Okay, I don't use this as much, but it's definitely another indicator, or another another liquidity pool you can use. So we're just going to open up the kill zones indicator, and you can see London high is always going to be marked on this, and London low is going to be marked on this. So how to use this London high or London low? Well, what you do is you wait for the London high or London low to be hit, and then you look for a reversal model. So you can see here's London high, here's London low. You can see London low gets hit first. Now here's where I'm going to wait for like a market structure shift. So let's see. So we got so we hit London low. We have a lower high here. Let me just keep playing price. Okay, another lower high here. Okay, here's a market structure shift. We got a fair value gap here. Here's where I'm going to try a long setup because we got our market structure shift. Okay, because I know we swept London low. And you can see would have been pretty nice profit. Okay, maybe you target the next high. Maybe you target London high. Like you could target London high in this example, but you can use London high and London low for liquidity as well, whether you're targeting them or whether you were waiting for them for hit and then looking for reversal off them. Another tip to write in your notes: you will not always get a long setup off of London low, and you'll not always instantly get a short setup off of London high. If that's the case, if we just keep dumping past London low, you're probably missing some sort of important liquidity void, equal lows, or something lower. Okay, if you see that happen, if you see us go way below London low without giving us any sign that price wants to reverse. All right. And then you can see we actually go back to London high. And we hit London high, and you can see we instantly reverse again. Why? Because it's just such a good liquidity pool. It's where a lot of stop losses rest. A lot of people place their stop loss above the London kill zone high, and a lot of people place their stop loss below the London kill zone low. And if the market wants to reverse, where does the market need to target? It needs to target stop losses. So London high and London low are just another example of a liquidity pool you could be using every day if you chose to. Now, if you're waking up in New York and you already see the London high and London low ran, like you can already see New York ran the London low here, already ran London high, then that means one, we're going to chop all day, or that means two, just use like the high that ran the London high as liquidity. So you could use this high instead. Definitely just depends. All right. So that's it for this video. London high and London low is a liquidity pool that you will likely use. And if you are trading London, you can use Asia high and Asia low, just so you know. And then equal highs and equal lows. So I do go over a few more in my course. If you want to get that, link will be in the description on the website. But that's going to be it for now. Let me know if you guys have any questions, and peace.